Hi, Mark.
Can everybody hear me?
Yeah, welcome to the summit, Mark.
Thank you very much. Thanks for having me, Dale, and Joe Perry, everybody else.
Yeah, so I look forward to it. Normally it's an interview, and I see you want to talk about volatility. I just have one question. And, people wonder how I remember things like this. But I remember one of our interviews, Mark, and if people don't know who Mark is, he's a CNBC contributing editor. He's on there a lot. He's a CMT, and he has a great website and one of the best tacticians I know. And this is why I bring it up, because before the break that we had in February, March in the market, you and I had talked before, and you had a time frame thinking that the market might have some strength into the end of April. And so we got the big break, but here we are at the end of April with a hell of a recovery. And, cycles don't always point towards the top, but it's still an important time frame for you, isn't it, late April? I'm just guessing.
You know what? Not as much anymore. And so, initially I'll say that,
All right, hey, hold on, Mark. I have to cover 1,000 S&P shorts I put on.
Yeah,
no, I'm kidding. Go ahead.
I don't want to say that that I'm negative now because I'm positive. I'm simply being a lot more tactical, and I really need the market to prove itself that it's going to go lower. There's a number of things that I show for right around May the 9th into the 16th, and I think that could be, an initial period where markets peak out. I think we're a little bit stretched today, but really any minor weakness today likely still holds 2,900 and then makes a final push higher. So I'm skeptical to try to
Is
come out.
3,100 realistic?
You know what? We can talk about a lot of those after I go through some of what I brought. I have a little bit more of a formal type presentation, and we can obviously go back and forth. But I want to discuss with the viewers what I saw specifically during January, February that made me concerned, and really what I see now. And there's really a lot out there, and I'll try to cover it as quickly as possible.
Take your time.
Certainly one of the more surreal, unusual times that we've seen on record. I mean, I've been in the business since the early 90s, and literally the last 2 months has just been, wildly exciting on both the downside and on the upside. And so, stocks have managed to really shrug off one of the largest periods of economic and earnings uncertainty. And that's really the key message, is that everybody was scratching their heads, first of all, as why the market was going down. And now those same are really scratching their heads as to how can this rally continue given lack of a vaccine, given lack of any certainty with regards to earnings or the economy or anything. And so truly a lot of things to be really frightened about. And many times that sentiment is actually more important than the news or what's around us itself, is to really study how those of around you feel about the market. We're set to make literally the largest monthly gains now in about over 25 years. So, we have a near-term pattern where markets are really not that overbought. MACD and other indicators are still positive, but that's also within the framework of a lot of weekly and monthly momentum that it really is negative. And so, you look at a couple of the key themes, and that our own bounce in the U.S. has been far stronger than what we've seen in Europe, Asia, and most of the LATAM space. I think that's interesting. Small caps and mid caps literally in the last week have started to show signs of moving higher and breaking out relatively against the S&P. And so that's really an interesting concept. It's not normally something you see at market tops. Growth has begun to slip a little bit. You've obviously seen that energy and financials outperformance of late. My thinking is short-term cycles show the potential of a peak in mid-May, but really it's going to be mid-July that I'm eyeing as to being important. And so, sentiment right now, we saw last week's AAII bulls down at the lowest percentage of the year. So it was down at 24% bulls. So that's really interesting that after a 30% rip in the markets that we're seeing the lowest percentage bulls. And I still look at that survey as being, something that I would include in my toolbox. It's certainly not a be-all, end-all, but it's very important. So, the monthly chart many people use log charts. I do myself, but this one actually did have 3 important hits to this longer term trend line in the last 10 to 11 years since the bull market started in '09. So I do think it was important. We actually held where we needed to on a month-end basis in March, and now we've snapped back. But the real warning sign to me is the extent that the momentum has really begun to roll over. That's a big thing. We hit our highest overbought levels on record really in January of 2018. For any of you that use the Bradley charts, the long terms actually peaked out in 2018 as well. That was a meaningful peak. And not just for US stocks, obviously we peaked out this February, but largely for when momentum globally peaked out, 2018 was the year. And so now we've had a decent rally off these lows. And so initially, let's just look back, and I'll try to cover these quickly, and then we'll move on to some charts. I know we all are interested in the charts, but everybody wants to know, what were the warning signs? I did turn bearish on the market in January and actually in February. And so my annual report for this year turned negative for the first time in over 5 years. And this business I just started in 2016. So this is the year that I came out in late December thinking this year was going to be a negative. These are some of the reasons why. Now, some of these materialized right away. Some of them started in January, February. The high yield started to diverge pretty meaningfully in mid-January. That was pretty important. We also started to see the defensive positioning. So all of a sudden, when you start to see utilities rip and outperform technology, you really have to scratch your head. The put to call started to dive. The equal weighted gauges hit new highs in January, but yet we didn't in February. So the market peaked out a minor peak. S&P and NASDAQ ripped back to new highs, but yet the majority of stocks did not follow suit. And that's a real key warning sign of some negative divergence that's really important. Small caps and mid caps actually peaked out in mid-January, so they didn't follow suit. That's also part of that whole equal weighted gauge that did not follow suit and move back to new high territory. And a lot of it was about breadth starting to really slump into February, and we'll look at that. But really, the treasury yields truly proved to be the catalyst. They have tended to show some decent correlation with equities over time, and when we saw not only the break in October of 2018 was yield-based and coinciding exactly with when Powell spoke, but also that happened in mid-January and also mid-February. When you saw the meaningful breakdown in treasury yields, that was the real catalyst for when stocks actually started to turn down. But the sentiment turned very bullish last November when the market had gotten through, September, October, thinking that nothing else mattered. Deal with China was underway. We saw very high levels of bullish sentiment. And so that was part of the process. That coinciding with these divergences are something that everybody really should pay attention to, in terms of things that can coincide with meaningful peaks in the market. So right now, there's a number of different positives. I mentioned some of them. We're still in an uptrend. We still have higher highs, higher lows. Momentum is positive. Technology is the big thing to watch. Tech is 25% of the market. We have not turned down in tech. So it's important to really take notice that the market's up 28%. We don't want to be too short-sighted and try to jump in and out of this, but really watch what happens with technology. That's going to be the key. Defensives right now are still underperforming. You look at not only over the last month, but over the last week, we've seen meaningful lagging in utilities and the REITs, and sentiment right now is still subdued. We've had a big rally in the last month, and stocks really, sentiment has not really snapped back. The negatives, though, are pretty overwhelming. We do still have a lot of bearish momentum. That's important. We still are within this negative momentum divergence, which I pointed to in January 2018. That's not going away anytime soon. The market cycles are going to be negative until at least next year and potentially into 2022. So this does suggest for me that it is going to be a rally to sell into. I'm just not willing to step in front of it right now when things like transportation and other laggards are starting to come back to life, and along with the small caps. So the transportation has been under pressure. That's something we'll look at. And the lack of participation is an intermediate term concern. And as I just mentioned, some of that has improved on a short-term basis. So here is our S&P chart as of yesterday. So we managed to actually break up above the peaks from April. A lot of people had noticed, correctly so, that breadth and momentum were stalling. But my thinking is the move up over April really changed that. And if anything, still very important for how this moves. So, this move for me should get up to, right now we're at 29.43, I think, in S&P futures heading into the Fed. So it's an interesting spot with regards to time. My thinking is, can it be meaningful in the short run, produce a minor pullback? This was the chart that I referenced a second ago, and this is just, the market had taken on this very choppy, overlapping type period and a corrective style that many thought should eventually give way and be a head and shoulders peak. Well, 80 times out of 100, these oftentimes do not turn out to be head and shoulders. We would have needed to get down under 27.27 in S&P, and now we've actually pushed up to new highs. And as of today, this looks to be, ending potentially a fifth wave from the 21st of April. And so we'll see if that actually is just a third that ends, today, tomorrow, we pull back and then have a final move up into May. My thinking is it's going to be early to mid-May that's going to be an initial peak.
Okay.
This is interesting, and then we're looking at the peaks from 07 and also the peaks in 29. So time is very, very important. We declined actually for 5 months before getting back 60%. So we're actually higher with regards to retracing this time around, and actually as of a couple days ago, our rally has been longer in time than the time it took to come down. So there has been an overbalance now of time. We declined for 33 calendar days. Now we're on day 37 on the upside and have gotten back about 61%. So it's interesting in that time we're seeing an overbalance. Most of these bull market peaks, whether it be 29, 2000, 2007, you look at this comparison where in 29, you barely got back a third initially, started to sell off again. This rally already on top, we're already an overbalance of time, and we've recouped a lot more than we thought we would have. So that's just, you could say the Fed is
imply that as bullish.
Well, it is bullish, I think, on a 2 to 3 month basis. Yes, the fact that that means that even if we peak out in May, I don't think there's going to be an immediate challenge of lows. I think that likely we could grind around till the summer, and it's important to see that negative divergence really come back. Growth versus value has definitely begun to roll over. That's something that's interesting and new. This is just a ratio chart of the SGX versus the SVX. You see that negative momentum divergence on the bottom. So I tend to plot these as a ratio form. Now, as to whether this is a longer term peak, I'll let the charts show us that. For now, I do expect that value can show some outperformance in the short run. But this is the chart going back over the last 20 years, and it's just a historic, huge period of outperformance for growth. And this largely kicked into gear right after the U.S. election in November 2016, not to get political, but obviously the perception was that we could see a lot of deregulation and good opportunity for business, and at least the perception was that that should be good for growth. That's precisely what we've seen with regards to growth. We've had huge outperformance. Now we are getting overbought in this ratio. The prior chart, we showed that this should start to peak out. So we'll see if the extent of this peak out, but for now, that's interesting. This is something that just happened this week, and this is very interesting. Small caps all of a sudden have broken out against the S&P as of this week. So it is a breakout. It's something that I am going to respect in the short run and thinking that we can make up further ground. So if anything, a lot of people are saying, hey, look at the Russell that's had a couple up days. Let's look to sell into this. Well, charts like this, holding suggests that we could actually show some additional acceleration in small and mid caps. But the ratio has just gotten really eviscerated. You look at this longer term sell-off. This is a mid cap versus SPX. Russell's the same. We've gotten down to decade lows in this. So you can afford to give a little back on the upside into May, into potentially the summer. That should be the time to sell into small caps. I just don't think it's right now.
Great look.
Treasury yields have lagged of late. I talked about the correlation. We have seen that over time. We saw the breakdown in January and the breakdown in February. It's been very choppy, and this was taken a few days ago. We've managed a minor little bounce in yields. Financials obviously have responded well. My thinking is we got to get down under 56 bips, and that would turn the attention towards a test of March lows. Right now, we still appear to be in a time when financials can work and actually yields can, we're certainly not going to see a giant rip back to the upside in yields, I don't think. But I'll let the chart speak for that. I mean, 140 is my level on an intermediate term basis. Until we get up over that, yields should be persistently very weak, and any sort of bounce in yields is going to be a chance to really buy into treasuries.
That's still a big bounce back to 140. It was
I don't expect that. So if we get over if we get over say 80 basis points, you can make the case for when we're going to start to see the rally. I don't think that we're quite there as of yet. So you really have to just lean on what's happening with regards to yields. Right now we're still at 60. So I don't see this. Yields are certainly not responding. In the past, that has been a warning sign. We obviously see the yen moving up. We'll speak about that in a minute. But for now, this is something I'm paying attention to. The dollar, I don't have a whole lot of conviction in near term. We've gone from a lot of violent whipsaws, both to the downside and the upside in the Dixie and the DXY. I do think this has a potential to, if we start to break down under 99, I would turn more negative, and really over 101, I'd be positive. And that's just my time frame of preference with regards to technically how I look at it. So, I think the dollar has made some very meaningful longer-term breakouts against some very important emerging and Latin American currencies that really deserves mention, and that we've seen it against the Brazilian real. This is a 20-year chart. I mean, that's a historic long-term cup and handle pattern. Same pattern against the peso, whether it be Colombian or Chilean or Mexican peso. We've seen very meaningful breakouts. And so, that should mean that emerging markets are going to continue to be under pressure. And I think that's been proven. We've seen the EEM only give back about a third of this rally, of the decline thus far, and our own U.S. markets have already recouped over 60. So until that changes, emerging markets are going to be something to sell into. Euro, obviously, this is a similar type longer-term daily time frame. We see this downtrend at work over 109. I would turn a lot more bullish on it, but for now, it's really something that one would probably want to sell into on a short-term basis after this bounce over the last few days. I don't see any signs just yet that it's broken out, so it's not, and that's just my time frame. The pound obviously moved up and held that important level from 19 and 16 and has now rallied up. Usually that'd be a time to consider selling into that initial bounce off the peak. And so maybe that dovetails with what Jamie was talking about, that we need to see a final pullback to, after this 5-wave move up as part of an ABC. And I don't necessarily disagree with that. This is a longer term weekly structure, but just shows you the levels that I think are very important to the bigger picture for pound sterling. EEM, as we talked about, a very weak rally off the lows. You are starting to see some interesting movement just today in what's happening with Brazil and Mexico that are really starting to claw back. And that's been a big picture of mean reversion all along, where, the retailers, the airlines, the casino stocks, the cruise line, all of these all of a sudden are making these giant moves off the bottom. And so, the weakest LATAM markets are actually doing that today, and actually are pretty bullish to me short term to try to buy into these, like EWZ, EWW. I do like that as a short term trade. The longer term picture, though, is still pretty negative when you look at just diverging markets, developed versus emerging, and really a longer term breakout in that. Commodities have been hard hit. This is just the equal weighted CCI going down to the lowest level we've seen in over a decade. So, I would argue that the dollar should be close to starting a meaningful turn back to the downside. But, until I see that, commodities are really something still that I want to avoid, with the exception of really the precious metals. And, near term, I do think crude moves higher into May. I do think precious metals are still moving higher. Copper's had a decent bounce, but I think the majority of the space has really been hit hard of late. Some of the
agricultural commodities.
Grains have been tough, softs, and so I want to see improvement in these longer term charts before I really start to pay them more attention. Crude oil, just a historic breakdown across many different times. This is just a monthly generic chart going back 20 years, and so you see the extent of this damage. And I am sort of short-term bullish on crude, into mid-May. But I think that really any rally is going to be something to sell into. I'm not certain that we can recoup the prior lows that we've seen, and those levels are not to the low 20s with regards to just generic crude from back in 08 or 9 and also 2016. So my thinking is you're setting up on an ABC type bounce for crude that does get us up into the low 20s. I would look to sell into that. For now, I do think there's some very appealing technical long opportunities in things like XOP, XES, the oil and gas ETF. I think they're making very good moves, which I think for those that are tactical, they are going to present opportunity. For most that are intermediate term, you simply use strength to sell into. I think the longer term cycle is still very much negative for energy and crude throughout the majority of this year. I think what people are saying about demand is going to prove to be 100% correct. That the amount that they can cut is not going to nearly measure up to the amount of demand being stripped away, 35 million barrels a day. And you had to try to press Mexico just to cut 400, and you can barely even get to 10. I mean, we're seeing an unprecedented amount of shortfall. So this likely is going to continue. Gold for me is still bullish near term. This is a week or monthly chart. I think we probably can still push up and test highs. I do have some concerns about just the positioning getting very long in gold. Silver obviously is not kept up. Those are all very good, points to make. But the charts are still very, very good to me with regards to both gold stocks and also the metal. So I'll believe it when I see it. For now, I'm a gold bull for the time being. I still think gold can work a little bit higher. If we start to see, the yen start to put a lot of pressure to the downside, and then, we'll see. I'll have to really, we'll see how that all shapes up. Sector-wise, I'll go over a couple sector views real quick. Just we're talking about equity sectors. Healthcare in the last 2 months has seen one of the largest moves we've seen in recent years, and some of that is a defensive play towards pharma. I think that's absolutely the right place to be. I think near term, this sector is getting a bit stretched, but I do think that, you really still want to be long the healthcare space. And, this is a longer term chart of XLV versus the S&P. You note that the sector peaked out in 2015. The last couple months have seen a big, big breakout to the upside. Healthcare is now the #1 performing sector of the year. Or so they say that, the least worst performer, besting technology. Financials, of course, broke down substantially, and it started in December. This was a key warning for the market. When you see a group that's ranked 13%, all of a sudden gets turned on its head, and some of that, most of it was yield related. Yields peaked out late last year, turned down, financials followed suit. We are seeing a little bit of bounce. We'll see if that lasts. For now, it's a concern that we've seen such damage in the space. Yields being persistently low, financials on a rally is something I want to sell into the next few weeks. This is also important, discretionary versus staples. A big breakdown in equal weighted terms. I always look at equal weighted. I think that's really important. People look at the XLY with all its Amazon, Home Depot, and Nike. Look, this is not the way to look at these ETFs or even relative relationships. Discretionary actually peaked out versus the market in 2018, right when the longer-term Bradley peaked out, right when momentum peaked out. So this has been really under pressure for a while, but it really was February when we started to see a lot of these builders, everything started to fall apart with regards to the retail space in discretionary, and that proved to be very important. So yes, we are seeing a bounce off the lows. Yes, this will be something to sell into eventually. I don't think it's just yet. Utilities on a longer term basis, and this is pretty compelling, arguably is at levels where we're nearing a very big breakout in utilities versus the S&P. This goes back since 09. Wow. So we haven't done it yet. Utilities have been a very big laggard in the last month and a very big laggard this past week. And so we're sort of churning, and this whole churning has lasted over the last year. So this is very much a weekly chart going back since 10 years. Important to know your perspective. My perspective is I am waiting for a time over the next few months when the markets start to turn down. At that point, I will trust it, and I will buy utilities with both hands and think that this group can show some meaningful outperformance at a time when yields should remain low and markets likely underperform this fall. Summation index gave us some major clues. I do utilize this. Some use, the simple McClellan oscillator and advanced decline and say, well, that was at new highs back this past January, and that's correct. But the summation actually showed a very material breakdown into February, and that's something that's worth watching. And we got down to where we only had single digits, a percentage of stocks above their 200-day moving average. Now we're up to 12. That's certainly not a great sign when markets have recovered 60%. So yes, this is a big warning sign. The majority of the rally off the lows has been large cap technology. It has been the growth stocks. Now we're seeing small cap come back a little bit. We'll see if this can start to climb. For now, it's a concern that the market has gotten back a lot of what it lost, and yet we still have 90% of all issues are under their 200-day. That means we've seen meaningful weakness. So I am not in the camp that markets rally back to new all-time highs. If that happens, that would similarly be a chance to sell into this move for me. I mean, breadth and momentum are certainly still very subpar on an intermediate term basis. The VIX is something which is down about 60% from its peaks, coinciding also with the S&P being up 60% from those March 23rd lows. Vol is going to be tough to use as a way to fight this market. It was obviously a great tool back in January, February, when 50 Cent, as part of the London firm, was buying those VIX calls at 50 cents, and it's just a different trade now. At vol at 33, you're going to need to find different ways of betting against the market than implied volatility. Vol has remained pretty firm for a lot of the right reasons, that we snap back with little to no reason, earnings-wise or fundamentally, and so that leaves a lot of unanswered questions.
Back then, Steve Volge said, Mark, that if there was someone I didn't like, I would tell them to sell volatility. That's my partner. Anyway, so, okay.
I've always been, I'm too much of a premium hog. I like owning everything and trading against it. So, not volatility necessarily at these levels. And look, I think if the VIX gets into the mid-20s in the next month, then it's certainly appealing to try to own, calls.
What instrument has the less decay to own if you want to own it?
Yeah, I think that this will be something that's going to be a great trade between, June, July of this year and October. And I think when the market finally does turn down again, that this can have another run. For now, it's just not something that's an attractive vehicle.
And plus they erode. Most of those ETFs erode.
So here's a final chart I'll just show real quick on just the AII. This is this is last week. So you see this percentage bulls, we got down to 24%. That's remarkable given the extent of the stock market rally we've had. Really is pretty interesting. And so this is one of the few things that I do use as part of my toolbox. I think it's really important to look at sentiment, and investors tell us intelligence is also important. So is DSI. It's just that we've had a big market move, and people de-risked on the way down, and they failed to catch it. And now they're looking at the fundamentals as to why they should get back in. And everybody's scratching their heads. They're saying these companies are, they don't have any guidance, and we don't know how to value them. So how can you be bullish on the market? And that's precisely a time when you should actually be trusting trends, and sentiment is saying, you know what? It might still be a little early to think that the peak is in on the stock market rally, because there's still a lot of people on the sidelines hoping to get their pullback, and it hasn't materialized.
Let us know when they finally capitulate and go long with both hands so we could short it, Mark.
Well, when you start to hear signs of those that are expecting the stock market pull back to the lows, all of a sudden start talking about new highs, that's when you want to watch out, and I think we're not there yet. I think we're not there. I think that, people that were slow to turn bearish are now slow to turn bullish, both from a fundamental perspective and some colleagues that look at just long-term technicals, and they have a lot of merit as to why they look at long-term. I just tend to find myself that when volatility strikes like it has, I want to be tactical. I want to be shorter term. To some, it's to each their own in terms of their own methodology and what makes them successful. But for me, I've always found a lot of success at trying to timing on like a 4 to 6 week time frame, or even shorter, over the next week, versus trying to look out a year and say, well, the market's going to be at 3,700 and these are my earnings estimate. I mean, to me, I just think that a lot of that stuff isn't applicable. I'm happy to use fundamentals along with my technical toolkit when it lines up, but I almost always want to lean on trend. I want to lean on sentiment. I want to lean on seasonality and look at momentum and breadth. And for now, I do think that a bear market did start. stocks can be 50 to 70% lower. That puts me probably out of consensus and saying shocking things like that. But I think that over the next year, people are going to come to grips. And even if the market snaps back and tests its highs this year into the end of the year, I think that'll be a chance to sell next year. I think we're not out of the woods. The cycles I'm looking at are longer term. They mean that we're going to be in a bear market for a while. So this is
what a great presentation, Mark.
Look, happy to take questions or go over anything.
Yeah, any questions for Mark? I'm looking through them right now.
Yeah, we do have one, for example, that I see here. We have a couple of them that have to do with Brazil. So one of them is, what is your comment on BRL USD? So that was one. And the other one, let me find it. There is a question also
about Dixie, but he already gave the answer.
Yes, he did answer that. And what's your comment on the Brazil economy and its interest rates? So we also have that question.
He doesn't even
Look,
cover
I don't pretend to have any big insight as to Bolsonaro or his quest to extinguish the Amazon. And I think those are all very important points. They're just out of my toolbox. They're not how I look at things. I'm not a fundamental guy. I'm not an economist. I think that when you see a meaningful breakout like we've seen in a breakdown in the real, a breakout in the dollar versus the real, that they are important. And yes, we've given some of that back in the last, specifically today. I think the real has rallied to about 539. So that's a good sign, I think, near term. But overall, I look at the chart of what's happening on just a weekly basis of the EWZ, and here's a chart. If we can put this into perspective and show exactly what's happening, I mean, this is really a pretty meaningful, short-term breakout of what's happening. So I put this out as a long idea. I think that we probably can get to 28, 29. I mean, that's over a 10%.
Mark, we can still see your contact information.
Oh, you didn't see
Which
that.
is important. Yeah, he didn't.
Which is important. Yeah, but I mean, if you think we're seeing a chart, we're not.
Yeah. And Mark, I have a question while you're doing that. Someone said, I wanted to know if you wrote that you thought, where is that now, that 70% of the 2009 to 2020 advance will be retraced.
That's just a figure I'm putting out there because I think the cycle is going to be negative next year. And I think that we've given back 30%. And I think that we honestly, can you see the Bloomberg screen now? And how I'm looking
yes,
at it?
Mark, we can.
So
we
this
can.
is something where, just a move from 09 would put us down to
1,500.
15. Right near 1570, 1600 were the two prior peaks from.
Yeah, isn't that a natural, that double top there? Yeah, that double top there's kind of a natural, isn't it?
So my thinking is 60% of that would get us down to 1700. So I'm thinking that's the area I'm looking at into late next year. And honestly, I think the pattern is retracing in a way that it's making it's going to make a larger head and shoulders type formation. And I'm notoriously, critical of those that label head and shoulders before they're broken. But I do think the extent of the damage on the way down is going to prove to be meaningful. When this does stop and pull back, this could turn out to be like we did from 29 to 31 in the U.S. markets, where we grinded around sideways. You might have a small pullback and then you grind around into July. When you finally start to turn down this fall, I believe that's going to be the time when you really got to pay attention to these lows that we put in. That they're going to be. So let's.
Okay. Thank you, Mark. You want to put your contact information up there again?
Sure.
Coach, we have a couple more questions for Mark. First of all, thank you. Good presentation, and so I wanted to transfer that. Somebody's asking for your view on the EU, UK, and US economies after the pandemic. So, in essence, how do you expect they're going to rebound following, the end of this pandemic?
Is there going to be an end to this pandemic, and when?
That's another great question. I
Or
wish I
Nostradamus.
could be that smart to
Right.
say it's going to
Yeah.
end here. I think that, I know much about the pandemic as all of you. I think that they
Yeah.
tend to come around every 18 to 20 years that coincides with a pretty key cycle that gave us back in the early 90s SARS back in 92, and prior to that, the AIDS, HIV back in the early 80s. So I think that that's part of a longer term 100-year cycle that was also very important to give us the the epidemic back in 1918. In 1818, we had, smallpox and there's been a lot of things over history. I think the next couple of years we'll find a way out of this. Obviously, the sooner we get a vaccine, the better. The stock market is going to tell us all we need to know in terms of the recovery. And so that's going to be very, very important.
Okay.
I tend to look at the movement in, Europe as just being
Mark, by saying that you assume that the stock market is going to tell us all we need to do to know about the recovery, in essence, you're assuming that the stock market is going to recouple with the real economy. Because to be honest, so far, what we have is unprecedented conditions, meaning economies being in complete lockdown and GDP plummeting, and the stock market that seems to already be dismissing that.
See, this is the Stocks Europe 600. This actually has gone nowhere in the last 20 years. So this is a fascinating chart that shows you the extent of which the cycle that started in 2000, that typically allows for a 20-year cycle that it's going to hit the latter part of this year, normally suggests a period of underperformance. And Europe certainly has. The U.S. obviously peaked out momentarily and has had, two huge bear markets. Count this as being the third, I guess, from February, and really two tremendous rallies back from 03 to 07 and also 2009 to, late 19. So
also amazing long-term divergence on the RSI on the monthly, I see there.
Yeah, and looks like it was just a little bit of a short squeeze to new highs, and that's it.
This is the Eurostoxx peaked out in 07, has never been higher, and its peak also came in 2000. And so look at the degree in which this has lagged over time. This doesn't necessarily make me think, the European economy plays catch up. If anything, I would argue that the economies and the job that we're doing here, the ammo that the Federal Reserve and the Treasury have thrown at this market, I'm hopeful that the U.S. continues to outperform. I think that if the dollar really starts to roll over and join this 8-year cycle, that, potentially we could start to really weaken. And, maybe that's the time to really get more involved in emerging markets. And right now, I don't think that's the case. So until that happens, it's tough for me to make that call. I think domestic markets are the way to be. Emerging markets have lagged. Most of my calls on Brazil and everything else are very short term. They're really 2 or 3 weeks based on specifically what's happened in the last 48 hours. So I'm not a long-term buyer of any of those long-term laggards. I tend to think that those are still going to face substantial amount of pressure, and that really rallies over the next month or two are going to be something you still want to probably sell into.
Thank you, Mark.
Thank you, Mark.
So, Mark, the best way for people to follow you, Mark Newton CMT on Twitter, and your website. You want to show it?
Yeah, that'd be great. So, in general, I started my own business 4 years ago now, and providing technical analysis for both individuals and also institutions. I work with a lot of RIAs and wealth management firms, and this is something where
there it is.
This is something where I provide technicals on largely a tactical basis. I keep on top of the S&P trends. I am largely equity focused, though I do have probably much more of a tendency to look at FX and just treasury yields in general. I think a lot of them are very much interrelated. So I offer a trial to those that would like. Simply, if you go to newtonadvisor.com, then a form will pop up within a few seconds. You can fill it out, and I'm happy to add you to a trial, and we can go from there. If you want to ask me a personal question, personal meaning direct individual, then just go to info@newtonadvisor.com. It's a general mailbox, and Happy to field your questions when I get time. And until then, I publish a lot in StockTwits. If long and short ideas are what you like, I have my own room I run in StockTwits that has been largely very successful. And that's only long and short ideas, but I provide those also to people that are clients. So you can join at a very reasonable rate as an individual. If you're an institution, I'm happy to work with you as well. Obviously, the more customized work I give you, the higher the fees are there. So, but happy to work with whatever it is that you can do. So yeah, I just want to wish all of you, the utmost in safety and happiness and good health in the days, weeks, and months to come, and stick together because we can all beat this. I have some Q&A questions, and let's see if I can. People are asking.
We did cover them, I think.
We covered them.
Yeah, I think I covered the majority of them. I don't use a lot of VWAP in my day-to-day work, but it is something
that was for Jamie. That was a question asked for Jamie.
Wonderful. Yeah.
So Mark, I want to thank you for what you contributed to the summit today. Thanks for walking to the flat part of the mountain and hanging out with us today, Mark. And what a great presentation. You know what? They're better if I don't talk too much. So
well, I figured I would just lead. I knew you would get a word in somewhere, but
it was great. It was great listening, Mark.
I'm happy to send this out to whoever would like. I have a copy of my presentation, so feel free to email me and I'll pass that along. And
we will also make available the recording, Mark. In a couple of days, recordings are going to be ready and they're going to be uploaded and mailed to people, so they will be able to rewatch it again there.
Thank you very much. Well, thank you for all your time today, and I appreciate everything, and happy trading and investing, and have a great time going forward. Best of luck to all of us.
Same to you, and
thank you, Mark.
Don't forget, tomorrow there is the second and last day of the event. So today was great. Tomorrow another great day. Coach, why don't you?
Thank you again, Mark, my trading warrior brother. Good hunting. For those of you, you're very welcome. Our sponsor being IG. You can open an account with IG no matter where you are on the planet.
I put the information in the chat, by the way, for people that want to.
Right, the info is there. So even in the U.S., it's nice to have another choice as an FX trader. I believe they trade other instruments as well, but FX being their specialty here. So consider IG, go to their website, check out their rates. As Justin said, really courageous of IG to give U.S. citizens another choice. They had to go through a lot of hoops and costs, so it's worth giving them a look. And there's never a log as having more than one account. So you could have one account where you are right now, and you don't know if you have a good racehorse until you run it against another. Consider IG and the links that we have. Also get ready for another great day tomorrow, Warriors. We have a great lineup tomorrow. Looking forward to continuing this summit. And in the meantime,
same time, of course.
Same time. Good luck with the Fed today. I don't know, has the Fed, Paul, spoken yet, Steve? Or
no.
I still have time to scalp my brains out.
You do?
That means a haircut? No, just kidding. So thank you, everyone, for hanging out with us.
And by the way, tomorrow, Dale, we have Boris Schlossberg, we have Adam Button, we have the CMT Association, we have this guy, Blake Morrow. I'm not sure who he is.
Oh, yeah, I've never heard of him. Peter Goodburn.
We have Stephen Marcantonio, and we also have Peter Goodburn and Lydia Finkley.
Yes, and Cable Queen. So tune in tomorrow, and it's our mission to build up and edify traders every day. Hope we did that today. Thank you, Steve. And above all, don't just count your pips, count your blessings. Adios, everyone. See you tomorrow.
Bye-bye, everyone. See you tomorrow.
Welcome, everyone.